Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update. I haven't done one since May 14th, but I want to play you a little clip from that video from May 14th real quick, just so we know where we are, where we're headed. So here is that clip from the video May 14th.
I still think that the mega caps, because they are so heavily weighted, can pull the S&P above 4,200. What that would do on a trend basis is give us a higher high. Above 4,200, we do have that higher high. I think what will happen is a lot of people that didn't see this rally, that didn't participate, that were still bearish, because we were in a bear market until this point. We're in an intermediate lateral trend in most of the indices. But I think what you'll see is some FOMO, some retail chasing, maybe some hedge funds chasing. My most shorted index is at the lowest level it's been since the end of the 2020 COVID crash. So there's a potential for some short squeeze driving the market higher. But I do believe that if we do get over 4,200, and this is just my thesis, we have to watch what actually happens if that happens. But I do think that we will see selling into that strength by smart money. And as we move from phase one and as we move into phase two, which is the market starts to get more worried about the economic recession.
So there it is, what I thought 2 weeks ago. We had this 7-8 week range of kind of lateral chop, nothing. And we did trade above 4,200 a couple times, did not close above it until Friday. So right there, 42.05, exactly what we were looking for. Now the NASDAQ actually did all the heavy lifting. So the S&P on the week was only up 0.3% for the entire week. The Dow was down 1%. Small caps were unchanged, 0%, but wait for this, NASDAQ 100, boom, watch this chart. It's amazing, up 3.6%. Here is where we expected and we saw the mega caps rotate in January. And look at this huge price candle on Friday. So this is a very bullish trend, and because of the weight of the mega caps, we pulled the S&P above 4,200 as we have been expecting. For the NASDAQ 100, this is more than a new one-year high. So if we look at it back here, levels that were last seen, going all the way back here to April of 2022. So very, very strong performance from those mega caps, which is part of what we expected. But this is also part of what we expected to go from a primary bear trend to a big choppy lateral sideways intermediate trend. And you can see that in a lot of other places, like small caps, and here is where we come into that low in October, and we're just kind of lateral since then. Before that, it was a bear market. So if I come back here, lower lows, lower highs, and a primary trend, bear market. This was the call that the first hint I got of it was August, and then we started looking for bases into October. The Dow led the first part of that rally, so over here, and then did nothing since then. And then in January, expecting the mega caps and the NASDAQ 100 to rotate in. So as I was saying, like one of the last videos, you can have the direction of the market right, which is a big call, to go from a bear market to what is more than a bear market rally. This is much more than a bear market rally. So getting that right is huge on its own, but knowing where to be to capitalize off that is even bigger. So if you were in the Dow that whole time, you basically got nothing out of the Dow in 2023. Year to date, I think we're right about here. So less than 1% of a gain. But if you look at the NASDAQ 100, which was the call year to date that we were going to rotate in, you are looking at almost a 31% gain. So less than 1% in the Dow, but big difference on where you are. So you have traders now who are bullish, looking for AI plays. What companies are going to benefit from AI? So we saw NVIDIA, right, have a huge blowout earnings. I mean, look at this gap, just monstrous. 28-29%, right? So the market is kind of looking for the AI winners right now, and then it wants to short the AI losers. Who's going to be a loser of that? Education, services, stuff like that right now, but eventually I think a lot more than that. That's another video. So just to drive home that point of rotation, what I have is the S&P 500 in the red and green candlesticks, and the blue line is the mega cap growth index. I think it's MGK mega cap 300, something like that. The only reason I use that is just to be consistent because I compare that a lot to a lot of other things. So here is all-time market highs 2022 and coming into the bear market. So this is normalized. This chart is normalized as of this point far left. You can see the mega caps really underperforming in 2022 because rates were going higher and the mega caps valuations had to be discounted. Now watch what happens when we move into January 2023. I'm just going to do that by sliding forward. So remember, very left side of the chart is where prices are normalized. And we come into January 3rd. So you can see the mega caps just blowing away the S&P 500. That's why I talked about in the former video 2 weeks ago that I think these mega caps are going to pull the S&P 500 above 4,200, which we got. Wasn't looking for the S&P to trade above 4,200 intraday, but to close above 4,200. So if you're a member and you've been listening to what I've been writing since last year, and you know that I was looking for the mega caps to rotate in coming into 2023, you also know that I said that I think market breadth is going to get really bad. It's going to start to get really ugly as money flows from everything else that was working from October to basically November, the cyclicals, the defensive sectors, and it was going to flow out of those and into a dozen or so really heavily weighted mega cap stocks. So I want to show you that real quick because we're already seeing this market breadth get thin. Okay, so what you're looking at now, again, is the S&P 500. It's an hourly chart, and the white line is just an equal weight index I created of pro-cyclical sectors. These are the ones that do well at the start of a new growth cycle, the start of a new economic expansion. We're at the end of an economic expansion moving towards recession. But we're looking at this area from the October lows where this whole rally started. And you can see the cyclicals actually led the market higher right here into October. They do a really good job keeping up with the S&P or leading it until we get into this period over here of March, April. What's happening? Money is going into those mega cap stocks. Let me show you one other. Same thing, same time period, S&P, but this is a list index equally weighted of defensive or counter-cyclical sectors. You can see them performing well early on in the rally. We get into the new year, and for a couple of reasons, I think. One, money is flowing out of them. You can see the relative weakness over here, and is going into the mega caps. Two, the market is getting more bullish. So when the market is getting more bullish, they don't want to be holding defensive sectors, defensive stocks. They want to play what is moving. So as all this is happening, when you start to look at market breadth indicators, what you'll see is they don't look as good anymore, which isn't really a problem right now at first. 2022 was a year where we were in a bull market making all-time new highs, basically being led by a handful of these stocks and some of the worst market breadth I have seen in 2 decades. But we were still able to make new highs and, be in a bull market for the entire year. But what happened is, as soon as we got in 2023, fell apart into a bear market. The risk is when you have a thin market, you don't have participation, you're depending on 6 or 12 really heavily weighted stocks. If something happens to those, you just have a big air bubble and you can see the market come down real fast. So the more we go on with this mega cap theme, the weaker the market is going to be under the surface. You won't see that at the index level, but as you look at market breadth and stuff, you'll see that. And we're already seeing that. So this is my whole thing of phase 1 rally on peak hawkishness, peak inflation, and phase 2 is going to be the market coming back down as the market starts to focus on recession. So here again, we're looking at the S&P 500 on a 4-hour chart. Here's the beginning of the rally in October. And what I also want to see was, above 4,200, which is number one, a new higher high for this rally. So that keeps that intermediate trend in rally mode. Number two, it changes psychology. So there's going to be a lot of bears that have trying to short at 4,200, goes above 4,200. You're going to start to see more short covering. You're going to start to see people who missed this rally getting bullish. And we're already seeing that kind of stuff. So I think it was just this week alone Citibank had to come out and they upped their S&P target to 4,300. Bank of America, that was kind of bearish on their take on the market, they followed in lockstep. They upped their S&P target to 4,300. So we're seeing that psychology change. That was the whole point of getting above 4,200, that we would see dumb money, we would see short covering, chasing this rally, and that we will see smart money using that price strength to sell into. That's distribution. It may not be evident on the price chart itself, but that's why I have indicators like 3C that are looking for the underlying trend, whether it's accumulation or distribution. 3C has the power to contradict price. Here's the NASDAQ. Again, the NASDAQ 100 that is just flying. If you look at the video I just showed a clip of from the 14th, I was showing all of the averages in this kind of lateral range. The Dow down here at the bottom, IWM, small caps, not even close. S&P was about in the middle. NASDAQ had already broken out. So this was leadership. But what I just want to show you real quick is that this is not a typical bear market rally. Typical bear market rally would be something like this or something like this, but not something that goes 1, 2, 3, 4, 5, 6, 7 months. That is not a typical bear market rally. That was the whole reason that the call last year was that we were going to go from a bear market to something different, like an intermediate lateral trend with a positive bias, but not a bear market rally that's just a sharp rally and then come down to a new lower low. And as you can see, we don't have that big, huge price candle on this. Look at this thing. I mean, incredible strength. But even in the index, let me go to a daily chart, even in the index that is doing the most, doing the best, NASDAQ, you can see the percentage was up on that day. That is Thursday, up 2.45%. NASDAQ 100, less than half of the stocks on that day in the NASDAQ 100 were green. So it is really those heavily weighted stocks that are driving the market while others aren't participating. That's where you see weak market breadth, and that's where we're seeing it even in the strongest market average. But we still have really bullish price action over here. You can see both flags. Still a lot of price strength. I wouldn't go shorting this yet, but we are seeing what we expected to see. And the white line is the NASDAQ 100's advanced decline line. You can see it right there. So here we get this new high in the NASDAQ 100, 1+ year high, but look at what is happening to market breadth. It is falling off. It's not confirming here. Here is the much broader NASDAQ composite, okay, and its advanced decline line. Here is our rally from October. You can see good participation in the early part of the rally, but look at what has happened since March. This is a big divergence, like alligator jaws just waiting to slam shut. So these are the things you're not seeing at the index level where price is flying. And here's the S&P 500 in the NYSE's advanced decline line. Here is the start of our rally. So pretty good confirmation. This is probably one of the better looking, but we can see a little divergence here and where we're expecting it above 4,200. Now, I'm not going to show you everything because that's kind of for my subscribers, but I do want to give you a heads up of what's going on because I want people to succeed in the market. I'm going to show you a couple of things that have been popping up. And what you're looking at now is the CBOE skew index. It's not really important to explain how it works, but basically what it is a measure of tail risk, basically hedging black swan risk, something that you don't see coming, right? So the last time we had some really red alert levels, we're back here. So what I would call red alert level, if you look at the CBOE's white paper on how to use the skew index, same people put out VIX, right? Generally runs between a range of 120 or 110 to like 125, 130 is considered kind of like a normal range. Nothing too crazy going on. So over here, we're above 150, right? This is December of 2021. Bull market high, absolute high. What happened coming into January? We started our bear market. Over here, again, the skew is at a pretty elevated level. I think that's pretty close to 150. We had a 20% decline in the S&P from there. What I have been seeing is smart money, because they're usually the ones who use this kind of hedging strategy, are buying deep out of the money puts to hedge tail risk. I assume that tail risk is the debt ceiling, the U.S. Debt ceiling negotiations, but I don't know for sure. But we are definitely approaching like red alert levels at 150. I think on the CBOE's white paper, they don't even reference 150 as a possibility because it wasn't hitting numbers like that before. But this is really telling us that risk is ramping up. Smart money that generally hedges with this strategy is hedging downside risk. Black swan risk. Back to looking at the S&P 500, this white line is my own custom, I call it leading indicator index. So it's basically a couple different forms of credit, and what I want to see is it track pretty much with the S&P. You can see where it diverges right here. The S&P takes a pretty sharp drop, but generally speaking, since this October rally, it's confirmed well. Look what's happening over here. Over in this whole area, it's just getting worse and worse and worse. And I know why it's getting worse. It has to do with yields, but this shouldn't be happening. All these things, a whole bunch of things are really starting to pop up where we didn't see them at all in this part of the rally. So I'm just going to briefly touch on what I think happens. The thing I cannot talk to, or I cannot speak of, is what happens with the debt ceiling. I have no idea. That's like a coin flip. First, let me show you what I kind of expect. So we've got the NASDAQ doing a really good job of leading the market since January, looking very strong. I mean, I can't short this. I wouldn't advise shorting this. There is a chance that we see small caps rotate in, but I don't think it's a very big chance. What I'm kind of looking for is a resolution to what I've been calling my phase one, which is the rally, the phase one, where the market front runs the Fed and sees peak Fed hawkishness, peak inflation, basically front runs the Fed pausing, which I think is already on the table. I don't think they hike in June. I think the rate hike cycle is done. But what you'll typically see, the Dow led the first part of the rally off these October lows. One of the reasons why I was really bullish on the Dow rather than like NASDAQ, it had a nice base right here, like a W bottom base or double bottom base, right? But it only led into November. After that, it didn't do anything. 20% move here, didn't do anything after that. Then we got rotation into the NASDAQ right here in January. So what are these months? These are the end of a quarter, the start of a new quarter, end of a quarter, start of a new quarter. So if I had to guess, I would say that we get done with this part of this rally that we've had since October by the end of June. Could it happen before that? Absolutely. Is it possible maybe small caps rotate in? Let's take a quick look. So here's IWM small cap chart. It looked like we might be getting like a little bit of an inverse head and shoulders over here. Right here, right here. Volume is exceptionally important to confirm these, and the volume right here is the most important, and it did not confirm, right? So maybe we have something like that again where it's a really misshapen, big inverse head and shoulders. But, I don't think it's a really high probability. We did break above this resistance level, which was like a first thing that it had to overcome, came right up to this kind of neckline, pulled back, held support there. So could we see some rotation from now into the small caps? Because people who are now turning bullish are looking for the bargains. They don't want to chase stuff that's up 26% year to date, right? So they're looking for the bargains. What would have to happen here is we'd have to see regional banks really start to outperform. And are they really starting to outperform? No, but they're starting to peak around this neckline or this trend line of resistance. So possibly, we could watch this, but I don't think it's a real high probability, but possibly. In summary, what I think happens is S&P above 4,200, we probably start to see some short covering. Haven't seen a lot of short covering. Actually, we did right here in the beginning of May when we were in this kind of lateral range. It was odd. Any case, start to see some short covering, start to see some FOMO, some chasing. We start to see mom and pop retail who missed this rally, chasing it, looking for bargains, stuff like that. But I do think what we see is smart money use that rally, that price strength above 4,200 to sell into. And that is basically what I think, but we have to look for confirmation of that. We have to look for distribution. So here's an example. This is QQQ for the NASDAQ 100, right? And here's February. This is as far as I can go back, but I've been using this 5-minute chart to track the trend from October. In any case, this is where we have NASDAQ and mega caps rotate in. 3C is doing a wonderful job making higher highs, higher lows, confirming until we get into the last couple of weeks and prices are sailing. So remember what I said, 3C has the ability to contradict price. So what you see at the index level is price moving up, looks very bullish, but what you see on 3C is smart money already starting to sell into that strength. They don't want to sell into a market that's crashing. They want to sell into strength. They want to short into strength. We want to do the same thing. So this is not at the point where I would say, hey, look, the market is about ready to turn, but we want to watch for more evidence of this, especially as the S&P has closed above 4,200. There's one real major risk that is immediate, and I think it really has to do with the debt ceiling. Bonds have been sold and yields are really way too high right now to support these kind of valuations in the stock market. This is a very recent thing over the last couple of weeks. So I think it is definitely related to the debt ceiling. S&P futures and the US dollar index in blue, but it's inverted. So there's been a very, very strong inverse correlation between the US dollar and stocks and also yields and stocks. So US dollar and yields have kind of been moving together and they've been moving opposite of stocks. So that's why I have it inverted so it's easier to see. You can see dollar weakness right here. That's dollar weakness making a, remember it's inverted, so it's making a lower high. That's the start of our October rally. Good confirmation. You could see this tax loss selling at the end of the year in December of last year. That was basically selling all the mega caps that really performed horribly in 2022. The dollar index over here is weak. It is supporting this rally coming into the new year, right? Still doesn't look bad, but even right here where we have a minor divergence, you can see what happens to price. That is happening again right over here. I'm going to go to a little closer look. And this is just a 2-hour chart of the exact same thing. So here's the March low. The market rallied. Remember I showed you this divergence. Price came back. We even have a little positive divergence here. Dollar weakness helping kickstart this rally. But here are those alligator jaws forming where we're seeing price go up. But this is dollar strength. This is not good. It is not supportive for the market. It looks a lot worse on this chart than the 4-hour chart. So it's not at a horrible level yet. This is something you definitely want to keep an eye on. And here's the exact same thing, S&P futures 4-hour, and the blue line here is not the dollar index, but it is the 10-year US Treasury future. Remember that Treasury futures, the price moves opposite yields. So when the price comes down, that means yields are going up. What do we have over here? Same thing as the dollar. We're seeing hawkish moves in the dollar, in yields. So this drop in Treasury futures prices is a rise in yields. So we get this alligator jaw over here. I can show you real quick. And this is just the 10-year yield, okay? And over here, so 37 would be 3.7% in the 10-year yield. This is the February hot data trend, and that caused the market to pull back through February. But what I was telling my subscribers at the time, as soon as this trend breaks, that's a window that opens for the market to rally about mid-March. That was because of SVB, but yields came down. What did the market do? Rallied from mid-March. We've been in this kind of lateral range over here. This is what I'm concerned about, this recent rise in yields, the recent strength in the dollar. These are not supportive conditions for stocks. Perhaps, if the debt ceiling is taken care of, it's voted on, it passes, perhaps we see this come back down and normalize. It will not change my view that we will still see distribution into higher prices, probably going into the end of June, could be sooner than that. And then we'll start to see what I have been calling phase 2. That's the market starting to worry about recession. So you already have Germany in recession, technical recession, 2 back-to-back quarters of negative GDP with the DAX near all-time highs. We're already seeing all this stuff. The recession is baked in. It is coming. My view has been the second half of the year, which lines up really nicely with selling these stocks distributing, getting out, dumping them on mom and pop investors, dumb money, and then getting ready to go short the market as we move into the second half of the year, where I expect we will be really focusing on recession in the U.S. So for now, that is it. It's a lot of stuff. If you're a subscriber, though, you're familiar with all these things. If you're not familiar, you want to become familiar. I post this stuff all day, and I show you why. I show you when it changes, the really important stuff that moves the market intraday, all day long as the market is open. That is going to do it. I hope everybody has a fantastic Memorial Day weekend. My birthday is Tuesday, and I'll see everybody on Tuesday.